Okay, welcome back. Today in how to win with investment properties, part three. We're going to be talking about financing. So the big question is, how are we going to buy these investment properties? So we know what we want to buy, we know where we want to buy, but now we got to figure out how we're going to buy it. So if you have cash, then it's easy. We can pay cash. But unless you have lots and lots of cash, even if you can buy one, and you want to scale this, you're going to be out of business after one. So we need to figure something else out. And typically financing is the way to go. Some buyers will buy cash initially if they can, only because it gives them a competitive advantage in a competing offer, and then refinance it and pull their cash out. So that's a strategy if you have that as availability to you. Now, early on, we talked not a lot about apartments because we said that that really isn't the place for novice or first-time investors to go. Even experienced investors, I would still say, shouldn't be doing the apartment thing necessarily. But if you do apartments, the lenders will finance your property based on a capitalization of the net income, and they'll have to have you have a certain debt coverage ratio, which means you can't have the money coming in from your rents equal the money to pay off or pay out your expenses. They want you to have cash flow. And that debt coverage ratio typically is 1.2, maybe 1.4, but it's not going to be 1-to-1 or below where you would have to feed it. So uh, that's how commercial properties are underwritten, based on the cash flow and the net income. So again, since we didn't talk much about apartments, we're going to skip over that discussion. And we're going to move on to how you would be buying properties most likely in the 1-to-4 family market. So if you buy a house, condo, townhouse, twin home, duplex, triplex, fourplex, you're going to probably be using a conventional loan underwritten by Fannie Mae or Freddie Mac. And their guidelines are going to require you to put 20 to 25% down, and the interest rate is going to be a little bit higher. So if the prevailing rate was 3, for example, you'd be paying possibly 3 5/8, 3 3/4 for the investment property loan. So you have to have a larger down payment, and you have to have, or you do pay a higher interest rate. And that's to compensate the lender for the increased risk. For example, if you got in trouble, if something terrible hit the real estate market and all the properties went down, what's the first property you're going to probably let go back to the bank if your back was against the wall? If it's your house or your investment property, well, it's going to be the investment property, right? You're not going to be homeless and keep the rental property going, more than likely. So the lenders know that, and so that's why they require a larger down payment, so they have a safety buffer, so that you would sell your problem, meaning you would sell the property on the way down as the values declined, because there still would be equity. Or if they took it back, they've got a 25% buffer, after, well, they wouldn't have that much after the foreclosure costs and stuff, but let's just say they would have a 25% buffer if they had to take it back, but it would actually be less than that. So Fannie Mae, Freddie Mac is the type of loan that you would be getting. FHA and VA do not finance investment properties for investors. They do finance owner-occupied investment properties. So if you are a veteran, you could buy a 2-unit duplex, move in, and having put nothing down, as long as it's your primary residence. But if you're a veteran and you want to use your VA eligibility to buy a rental property, can't do it. Same with FHA. FHA allows you to buy with 3.5% down as an owner-occupant, but they won't finance investment properties. So that's why becoming an owner occupant first and moving into one of the multifamily units allows you that extra high leverage and saves your cash, because we just said that you're going to need 20 to 25% with a conventional loan and have a higher rate. So if you're willing to take that one interim step, if you're just starting out and you don't own property yet and you want to be a landlord someday, why not buy that investment property and use the low down and get the maximum leverage? You might even be eligible for some of the grants and other down payment assistance programs that aren't available to investors but are to owner occupants. So if you have that ability and you have the desire to do so, let's have that discussion about you owner occupying first, and then after a year or two moving out, keeping your rental at high leverage and buying the house that you would have bought in the beginning. So it's doing it in reverse, but it preserves a lot of your capital. You may get financing from a community bank or credit union, but if you do, they typically are going to be on a 5-year call or a 10-year call. What that means is that that loan will come due at the end of 5 years or 10 years, and then they rewrite it, they re-underwrite you. Now, assuming that everything is going perfect in your world at that 5-year point, you can still qualify, and the lenders are still lending, and then everything's great. But it doesn't allow you to capture the advantage of today's long-term low interest rates. So I would encourage you to do the Fannie Freddie route. And then, but again, it's all what you can qualify for. So if the community bank or the credit union or private money is where it's at for you, then that's where it's at. But the bank is going to have the cheapest, longest term money, 30-year money. And if life happens, and of course we all know life does happen, so you can be, riding high one day and at the bottom the next if, the wrong thing hits you. So you don't have to worry about that. Once you've got the mortgage, you're underwritten according to life at that snapshot in time. So life can completely change and they can't take it away from you. Like during the foreclosure crisis that we had, 08, 9, and 10 and into 11, some of the banks, because their capacity had changed on what they could underwrite, they actually did not further underwrite those investment properties. So there were cases where you might have been paying perfectly on your loan and it came on a 5-year call, a 5-year renew, and then you had to redo it. But the bank said, I'm sorry, we don't want any of your business anymore. And there weren't any banks taking that type of loan, which means that you either had to pay cash or find an alternative to pay off that building or sell it. But because the market was down, you were selling it at the wrong time. And that happened to a lot of people that were leveraged with community banks. So think long term, think about worst case, Fannie Freddie, 20 to 25% down. You can go through one of the large banks that I'm sure you all probably are banking at right now, or you can go through a mortgage broker. There are some advantages to both. I used to have a mortgage brokerage with my wife for approximately 20 years, and we were the primary delivery source for about a third of the mortgages back then. And we had lots and lots of outlets and choices and investors. So in the days of old, I think the mortgage broker really was more advantageous. Today's world, the small individual owner of a mortgage brokerage, it's very difficult. You have to be part of a something bigger. You can't have a small shop anymore. Effectively, that's why we closed that business. My wife is over at Wells Fargo and originates loans over there now, and has been for a number of years. I think Wells is wonderful. They do a tremendous number of loans in the market, either through direct originations or through buying them. They're not the only game in town, but they're a good game in town. And like I say, you can talk to a number of different lenders and get pre-approved and discuss their options. The mortgage broker today will have some of those same Fannie Freddie programs, but depending on the broker, they may have another set of investors. The Alt-A market, and Alt-A means a combination of a hybrid mortgage that is like a Fannie Freddie loan and lower documentation or flexible documentation loan. That market actually is back. That market went away completely back 10 years ago, but it's back. So you may go to a larger bank only to find out that the answer is no. And then you talk to a mortgage broker and find out that the answer is yes, with slightly different terms. So if you're told no, it just means that the person telling you no may not have the ability to get it done. Doesn't mean it can't be done. And so you need to know that don't take the first no. Hopefully all you hear are yeses. But if you hear a no, there are options. I've sourced a number of financing options. And then there's something called hard money that's available. Now, hard money is typically short-term money. It's not to be used long-term. You cannot use it on a primary residence. It has to be used for investment properties and or fix and flips. And it's expensive. It typically costs you 4 points up front and a rate of about 10 to 12%. Now, of course, those change all the time too, but that's typically what you're looking at. But some of them will go 90% loan to value. Some of them will go up to 70% of the after repair value on a rehab or flip. So if you're wanting to do that type of projects, then I would say you need to find a lender that's open to those types of projects, and hard money might be an option until you stabilize a property, for example, and then can refinance it. Sometimes a property that you might get a really good deal on might not be in the condition where it's financeable for a traditional mortgage, meaning somebody took the furnace or ripped off the siding or took the plumbing or whatever. But because of all of those situations or conditions on the property, you might get it at a severe discount. But you can't go to a large bank and say, hey, well, they do have rehab loans, specifically they do, but you may not qualify for that as an investor. In order to take that property to the level that you want to take it to, might need too much money, for example, for the work. In which case, hard money could be a very good option if you're able to buy it right. So every property is different. Most of you that are watching this are going to be utilizing a traditional 30-year Fannie Freddie 20 to 25% down loan, and you're going to get, you should always get on any purchase. And before I would work with you, you would need to get pre-approved in advance. The nice thing about the larger banks, like Wells Fargo, is they have the ability to underwrite files in advance. Now, I'm not saying they're going to underwrite you necessarily, but you may be able to get them to do that. And if you're pre-underwritten versus pre-qualified or pre-approved, you are a significantly stronger borrower in the eyes of a multiple offer. Pre-approval and a pre-qualification, the difference is that all of that information hasn't been verified and vetted by the underwriter. So if something is later adjusted by the underwriter, it could blow up the deal. Whereas if you're pre-underwritten, that approval is solid. All we need is the property and the appraisal. So when you're in a multiple offer situation and you go in with a pre-underwritten letter and can demonstrate that there's no risk in me getting my loan, all I need to do is buy the property and get, have clear title, your offer will be viewed much stronger. So some of the larger banks can do that because they're the larger banks. They have the infrastructure and the staff available. Some of the smaller banks and the brokers don't have that ability. Doesn't mean you should shun them. It just means that the type of approval you're going to be getting from them is not as strong in the eyes of agents and sellers. So just something to think about. Now, if you decide to buy a building that's over 4 units, you'll be utilizing commercial financing. So Fannie Freddie don't do commercial financing. Small banks do, community banks do. That would be typically if you're buying apartments or mixed use type of properties. And I don't think, at least that's where you're probably going to start right off the bat. You may graduate to that or morph into that to some degree on certain properties, but probably not right off the bat. Other ways you can come up with capital, if you don't have that 25 or 20% down, might be from a home equity line against your home. The largest portions of where people have their wealth typically are in their retirement plans, meaning the 401ks, 403bs, 457s, whatever retirement plan they may happen to have, and the equity in their home. Most people don't have 100 grand sitting around in their bank account. They've got it invested somewhere. So it may even be in a stock portfolio. So how can you get at that? Maybe you don't want to sell that stock of yours that you've held that's gone up tremendously and you think it's going further. Depending on your brokerage arrangement, you may be able to get a margin loan and utilize that as capital for a loan, or as collateral, I should say, for a loan. It's called a margin loan. You need to talk to your broker to see if you are eligible for that. The risk would be, of course, is that if your portfolio that loan is against fell, you could get a margin loan and they may call that note and it's like 3 days. You got to come up with the money. So if you were to max out a margin loan and get a margin call, and your property's tied, that loan is tied up with money in a property, you can be in trouble. So, but that's an option. You may be able to take a loan from your 401k. You can generally take 50,000 up to 50%, whichever is the smaller of the two, and utilize that for a down payment on a property. A lot of people will do that even on their primary purchase. They'll use a loan from the 401k. Your 401k may have hardship provisions even for buying a home. Now that's for buying a home, not an investment property. But you may be able to take 10 grand out, for example, for that, or take it out of an IRA. So there are different rules with the investment accounts that allow for you to do that. Another thing that you could do, and again, I'm not endorsing it, I'm just making you aware of options. You could go out to YouTube right now and type in self-directed IRA for real estate. What you'll find is a lot of information on custodians that will warehouse your rollover from a 401k, a former 401k employer, into a self-directed IRA, and then that IRA is actually the entity that buys the building. Now, that would typically be a cash transaction, so you'd need a large IRA to do that with. However, you can get leverage on that, although that generates something called UBTI, which is unrelated business taxable income. So you don't want to go down any of these options without fully understanding all of the ramifications, which means talking to your accountant, talking to your attorney, talking to your financial advisor. I'm just providing you with information on options, not endorsing you to do any of them. The home equity line of credit against your home is what I see most often, or I see people refinancing their home altogether, capturing a lower rate and pulling the capital out. Typically, the rate against your house is going to be the least expensive form of borrowing. So we said that the cost of borrowing money to buy an investment property, you'll pay a premium, 0.5 to 0.75% more. But if more of that capital comes from your primary residence because you refinanced your home, then that's going to be at a lower rate because it's your primary residence that's securing that portion of that money. So if you're transferring equity in the sense from your home to your investment property, you didn't lose anything. It just moved from here to there. But some people don't want to do that, and that's just great. They want to keep their house sacred, and that's fine. But that is typically one of the ways that people find money, is through accessing equity that they have. Another way that you could do it would be to work in conjunction with a partner. So you may have heard this cliche. It's called a partnership is a ship you don't want to sail. I'm sorry. Having been in a partnership with real estate with a gentleman and his wife that didn't end so well, I can attest to that. However, had we not started that way, I would not have bought those properties. So in the end, we ran through some obstacles in the end, but it was what allowed me to go forward in the beginning to make those purchases. So if that's the only way that you can do it, I would say that might be something that you consider. And a partnership can be structured in a number of ways. You might bring the expertise and the daily work on it. For example, you'll manage the tenants and pay the mortgage and so on and so forth, and the other person may bring the capital. You may share duties. It's a partnership, and you have to have the division of duties outlined, I would say, in an agreement, with a partnership agreement, and with an exit in mind, because people have different goals. You may say, well, I'm buying this for my retirement and I'm going to hold it forever. The other person may say, well, I'm only in this for 5 years. Or they may get a job transfer and have to leave the state and no longer want to be involved, or have a life-changing situation, a lawsuit. Now they're sued and they have to sell it, or they're going through a divorce, or they're going through a marriage, or whatever. They may have a life event that precipitates them to sell, or needing to sell the property, that may not align with yours. So I would have that conversation with the partner. What if this, and this? How do you think? Make sure you're all on the same page up front. but also put it in writing. And ultimately having an agreement that if we can't agree, even though we think we can agree, that we'll go to arbitration or we'll have some form of litigation that will make this final, mediation, arbitration, litigation, whatever. But come up with an agreement to disagree and how to resolve that. That way you've already figured out your exit in addition to your entry. It's always exciting in the beginning because you've never done this and it's fun and it's great. But when the bloom goes off the rose and it's work, and you may feel you're doing more of the work than the other guy or gal, and all of a sudden there's hard feelings. And anyway, partnerships, if you have to do it that way, do it. If you don't have to do it that way, don't. Me personally, I could engage in many partnerships if I wanted with other people. I don't want to. I would rather own fewer properties and own them in my name rather than involve multiple people's and multiple, changing in life circumstances as they occur. So that's me personally. You may love them. You may love partnerships. You may want to bring in everybody, your friends and family and relatives, but that's not what I want to do. Another thing that you could do, and this is you have to be 62 years old or older. And this is kind of a novel idea, probably something you've never heard of or thought about, but you can use a reverse mortgage to purchase a property. And most people think of reverse mortgages as on their existing property, but a reverse mortgage, the HECM, which is the FHA insured home equity conversion mortgage product, the HECM allows you to buy a duplex, triplex, or fourplex as long as you own or occupy. So think about this. What if you were somebody that was a little older, you're looking to downsize, and maybe that you didn't save quite enough as much as you thought to live the lifestyle that you wanted in retirement. So you're faced with a couple of choices. You could downsize and move into, a smaller property. You're going to have to adjust to a smaller level of cash flow. You could move into an apartment, pay rent, or you could do a reverse mortgage and you could move into a multifamily unit, live in one of the units, and receive the rent from the others. Now, let's just use a duplex for an example. If you moved into a duplex with a reverse mortgage, and let's say that reverse mortgage or that duplex cost you $300,000, there's a formula that the FHA HECM is based on, and typically it's 50%. As you get older, it's more, meaning they'll give you more money, they'll let you borrow more because you're closer to the mortality table finish line. So as you're older, you get to borrow more because that loan is going to pay off quicker. But let's say you're 62, it's going to be about 50%. So you put down $150,000, you get a reverse mortgage for the other $150,000. Now with a reverse mortgage, you have to pay the taxes and the insurance to maintain the property, but you don't make the mortgage payment. I didn't say there wasn't a mortgage payment, because there is. The mortgage payment accrues through something called negative amortization. What that means is the amount that you would have paid in that payment goes on the back end of that mortgage. So if it was $150 year one, maybe it's $160 year two, and then $170 and so on and so forth. I'm just using made up numbers. But the mortgage grows over time. It doesn't decline like a regular mortgage because you're not making payments. Now you can make payments if you want, but you don't have to. So here you are, retired, living in one half of a duplex, receiving income from the other side from your tenant, and not making a house payment other than the taxes and the insurance. How would that improve that senior's life? Probably quite dramatically. Their whole outlook could be changed. Now, why don't you hear about this? Well, because the banks don't, at this time, aren't doing reverse mortgages for whatever reason. You'll typically be utilizing a broker, or as you watch TV, you'll see, the people like, Tom Selleck and some of the other guys talking about reverse mortgages. AAG and, I think Mutual of Omaha is doing them, and there are a number of companies. They're all legit, in my opinion. So call them, get their information, find out what a reverse mortgage purchase looks like, and then see if it might not work for somebody that you know, either yourself or for a relative that might be ideal for you. But it's really a way to increase their cash flow. So let's say that they sold their home and they had $150,000 to work with. They could control a $300,000 property, and instead of paying $1,200 in rent, they have no rent, and they're bringing in $1,200 from the other side. And so that's like a $24,000 improvement in their cash flow per year in that little example. So again, find out more about reverse mortgages. You can't do this as an investor. You have to own or occupy wherever you put that reverse mortgage on. So you can't move in and move out. If you move out with a reverse mortgage, you got to pay off the loan. So it isn't something that you can leave. Another option would be if you like your current home and you're 62 years old or older and you want to pull money out through a reverse mortgage, you could use that money that you pulled out. Let's say your home was free and clear, and then go buy investment properties, other ones that are free and clear that are going to generate income back to you. So if you had a $300,000 free and clear home, you put it and you don't want to move, but you want to buy investment property, you could take a reverse mortgage, pull out 150, take that 150 and go buy and leverage it if you want on more rental property, or just pay cash for one and then have the income and the cash flow from that. So there's a lot of creative things that can be done, but the reverse mortgage is kind of a sleeper. Nobody knows about it. So you're one of the first people that will have heard about it, and hopefully that will be helpful to somebody that you know. So that kind of covers the financing. And if you have any questions, let me know. But getting pre-approved and getting the financing done up front before any searching is done is of paramount importance, because we can talk in general up front to see if it might be something you want to do. But once you say, I want to do it, the next step is pre-approval. And we can send you to traditional sources and other sources. I know lots of places where I can, if you ask me, I would be happy to give you their names, and you can talk to them and see what they offer in terms of mortgage products, get you pre-approved, then we can go shopping. So have a great night, and I'll catch you in the next episode. Thank you.